You are getting it, my little bookkeeping boss. Now that you can calculate the debt to equity ratio, what does it actually mean? Well, the answer to that is it depends. What counts as a good debt to equity ratio will depend on the nature of the business and its industry. Generally speaking, a debt to equity ratio below 1.0 would be seen as relatively safe, whereas ratios of 2.0 or higher would be considered risky. Some industries, such as banking, are known for having much higher debt to equity ratios than others. A ratio of 1 to 1, or close to it, is normally considered satisfactory for most companies. In general, if your debt to equity ratio is too high, it's a signal that your company may not be able to pay your debtors. Not a good position to be in. But if it's too low, it's a sign that your company is relying too much on equity to finance your business, which can be costly and inefficient. That being said, sometimes a high debt to equity ratio can sometimes be positive for a company's financial health. For example, if the earnings that the borrowed money generates are higher than the cost of borrowing it. Debt to equity ratios vary from industry to industry. Different norms have developed for different industries. A ratio that is great for one industry may be trouble for another industry. So you see, when it comes to this ratio, it all depends.